So if you're still out there looking to buy your first house, this video is for you guys, because what you can't do is you can't paint the whole country with one brush to say housing market's going to crash, because unfortunately you get news like this out just today. The housing market update, the average US house is selling above its asking price for the first time in nearly a year. So what prompted this video is I get a newsletter every morning that reads this, and it's Mortgage Nuggets. If you're a mortgage professional out there, I would highly suggest you check this out. And I'm scrolling through the data this morning, and I'm like, oh boy, this is going to cause some people's heads to blow up. According to Redfin, and I know you guys are going to say, well, it's Redfin, Dan, they're a real estate company, they're going to give skewed data, but guys, you got to get data somewhere. And so many analysts, especially on the naysayer side of the equation, come out and say, they basically point out the same data that I do, but they use specific data. And let me explain it. So if you go through here, the average sale to price ratio, and this was what intrigued me, is 100.1% during the 4 weeks ending in July 2nd, marking the first time in nearly a year the U.S. housing market is selling above asking prices. And so we're seeing that right here in its context. Okay, so that's what prompted me to start really diving into this data. So if you go through here, let's analyze this data, because it's pretty informative. You go through here, and right through here, the median home sale price was $383,800, down just $1,000. Okay, so that's taking the whole country in general. But then you go down through here, and it says home prices declined in 22 of the metropolitan areas. Biggest areas was Austin, Texas, a decline of almost 10%. Las Vegas, down almost 8%. Detroit, that was a shocker, down 6%. Oakland, California, down about 6%. And Fort Wayne, Texas, down about 6% as well. But let's scroll down a little bit. Sales prices increased where? Milwaukee, Wisconsin. I don't get that one, but let's go with it. Providence, Rhode Island, up 8%. Newark, New Jersey, up 6%. Miami, now that's a curveball there, up 6.2%. And West Palm Beach, Florida, up 5%. Now everybody's writing off Florida as, well, you can't buy there. It's inexpensive. Nobody's buying. Everybody's going to, lose their money down there. But we're still seeing Miami up 6%. Palm Beach up 5% in Florida. Pretty good gains there. Okay, so let's go down through here. The median asking price of newly listed homes was $395,000, up 1.1%. So that's the data. That's really what prompted my video today. So what I'm trying to educate people with is, guys, if you're looking to buy your first house, listen to me for the educational pieces of the puzzle, maybe mortgage products, get an idea where mortgage rates are, but you guys have to do your own homework. Because if you're buying somewhere in, let's say, Austin, Texas, be very careful. But if you're buying in other parts of the country, maybe you don't have to be as careful. And I'm not saying just go out there and, write up a contract just because of, because a house came on the market. But what we're seeing here at our office is still house values. If it's a $350,000 house or less, we got contracts in the 4th of July, believe it or not, for houses in that category. So here's what I want to emphasize. If you're out there and you're like, hey, I really want to figure out if I can buy a house, we would love to consult with you, because we can go through these things. Do you have enough money to buy the first house? Do you have enough income to support that first house that you're looking for? Is the credit there? Are you in a financial position to do so? What I want you guys to ask yourself is this one question. Are you going to be there at least between maybe 3 and 5 years? Because if you're not, please don't buy. Because if you're not there at least 3 years or even 5 years in some of these areas that might have a little bit of pullback, you're never going to recover your loss. Because even if the housing market doesn't increase in value, if it stays steady, you're still going to lose money because of transactional costs. You're going to pay a realtor to sell your house. You're going to have additional fees for that. You're going to have to pay to sell your house. You're going to have to move, do all this other stuff. So it's not a prudent financial decision to buy a house just to live there for a year or two and try to flip it and make money. That's not how housing works. It worked in the last, in the near past, but it's not a long-term option when it comes to real estate. So that's the one piece of the puzzle I want to explain today. So what we want to also discuss on this channel on a daily basis is what economic data is coming out this week that's going to affect the markets. The one big thing we're focusing in on right now is the Federal Reserve. What's the Federal Reserve going to do at the next meeting? Because that's going to prompt what mortgage rates actually end up doing. So the economic calendar we have this week is basically, it fills up on Wednesday. Wednesday and Thursday are the two basically pivot points for the Federal Reserve. Why? Well, they have two mandates. They were created for two reasons. One, for price stability. aka inflation. The other was optimum jobs. So they want jobs at their full capacity. Okay. During this time right now, you might hear a lot of people saying, well, the Federal Reserve, basically, they're trying to crash the markets because they want to pull down prices. That's all video for a whole nother day. But what we're going to look at right here is this week, coming in on Wednesday and Thursday, is the CPI, which is the consumer inflation numbers. And then the PPI on Thursday is the producer inflation numbers. So those are going to give us inflation all over the map. And then on Thursday, we also have initial jobless claims. It gives us an idea where the jobs market is right now. So what we want to discuss next is the consumer price index. What is it? Why does the Fed give it so much weight? Well, what it actually is the definition of it is right through here. The CPI represents all goods and services purchased for consumption by the referred population. Let me get my head out of the way here real quick. The BLS has classified all expenditures items of more than 200 categories, ranging from 8 major groups: food and beverage, housing, apparel, transportation, medical care, recreation and education, and communications, and other goods and services. Well, if we want to go through here, we want to figure out what in the world is going on with the inflation front. So we look at the CPI. Now, these are all the numbers in the CPI, where we were back in November of 2022 and all the way where we are today. So you can see a lot of areas through here, especially in energy that I've been pointing out, is down dramatically. You have these numbers right through here. They're down double digits. A lot of other areas are starting to cool off. Okay, but then we still have down through here shelter numbers, and that number is still being represented right here in this area here, is that number is up 8%. Well, what I want to give you guys some context here is, yes, is that data accurate? Yes, it is. However, that data is basically lagging probably at least a quarter. What I mean by that is 3 to 4 months. So once the Federal Reserve, this data actually gets escalated to where we are today, when the shelter value is probably in the range of about 2 or 3%, you're going to see the inflation numbers, especially the CPI, dramatically dropping, probably in the tune of the mid to low 3s, maybe even possibly, if some of these other numbers come in line, in the high 2s. So what's the Federal Reserve going to do at the next coming meetings based on all the inflation numbers that we have today? Well, if you base it on today's numbers, the CME or the Fed is going to raise rates. There's a 92% chance that they're going to raise rates. So let me get over to the data that we're dissecting here. So we want to figure out with all the data that we do have is what the Federal Reserve is going to do at their next meeting. So there's a tool out there. There's actually a bond. There's actually the futures market at the Chicago Mercantile Exchange that'll actually give us this exact information. So what we do is we go to the CME group, and I'll leave this link down below. The CME Fed Watch Tool. This is telling us what the Federal Reserve is going to do at the next meeting. And there it is right here. What is the likelihood the Federal Reserve will change the federal funds rate at the next meeting? Well, that probability is, drumroll, 92.4%. So at the next meeting, the Federal Reserve is most likely, almost definitely going to raise rates. From there, we don't know. Okay, the charts are telling us this. Let's check the probabilities of what they're going to do at the next meeting. So if you get this out of the way, we have a 92% probability that, or a 90% probability that they're going to do it at the next meeting, raise the federal funds rate. Where we are right now in the federal funds rate is we're at 5 to 5.25. So that means we're going to move over to 5.25 to 5.5. You can see all those down through here. These are predicting between now and March of 2024, the Federal Reserve is going to raise rates to 5.25 to 5.25. Okay, so is this really what's going to happen? Well, probably not, because the Federal Reserve really doesn't know what they're going to do at the next meeting or maybe the following meeting after that just yet. So here's my analysis. I think I pretty much know the Federal Reserve is going to come in at this meeting and raise rates. Now from there, I'm all over the map. I don't know. And I always tell people it's okay to say you don't know, especially when you don't know, instead of guessing. Because you guys out there, the viewers, you guys are watching me for the content of, where my expertise is. Well, it's in mortgages, it's in interest rates, it's watching the markets, but I don't have the tea leaves or a crystal ball to let you know what's going to happen a month, 2, 3, 4, 5 months from now, nor does anybody else. So we watch this diligently to figure out what's going on in the housing market. So to conclude today's video, we got house prices that have not crashed yet. We have inflation coming in line. We have the jobs numbers that I actually like because I think it's going to put us into a soft landing. So overall, a lot of people have been telling you throughout the years, that's what we're trying to educate and inform you guys how to really find the data that's relevant to you. So with all this data that we have today, what's going on with mortgage rates? So to do that, what we do is we go over to here. This is what I see on my screen on a daily basis, and it's right here on your screen. What I follow here on a daily basis is what's going on with the mortgage-backed securities market. Because why? Well, why else should I watch? What else should I watch when I'm looking to figure out what is going on with mortgage rates other than the mortgage bond? Why would I follow a Treasury bond or any corporate bonds when I have a mortgage-backed security bond? We're seeing that's right in the middle of your screen right here. You can't see the numbers up here, the whole numbers, but this is giving you the price of a mortgage-backed security bond. The number back through here that's hard to read is saying 17. It's up 17. All I need you to know is that the bond price is up, which we're seeing today. It's up 17. It means rates are going to come down. There's a yin-yang and an inverse relationship. So when the number goes up, rates come down. When the price goes down, rates go up. And we've seen a lot of downs in the last year or two. So without further ado, where are mortgage rates? So to figure out where mortgage rates are, I go to Mortgage News Daily just to figure out where the national averages are. Now, guys, you can look at this. This isn't really going to give you that much data other than the direction of where mortgage rates are going, because the why behind it is Mortgage News Daily. What they do is they survey lenders all over the country and say this: if you have a borrower that has these five criterias, they're buying their first house, it's a primary home, and it's going to be a single family home. So it has to be those three types. The borrower has a 740 credit score, and they're looking to put down 20%. Now, you don't need 20% when you're buying your first house. In most cases, you need 3%. Some programs offer 0%, and there's grants and down payment assistance programs out there to get you into housing as well without any money down. So that's the criteria based on this information that we have right here. So if you want to find out, 1, can you get qualified? 2, does it make sense? 3, how much can you afford? 4, is your credit good enough? 5, do you need a realtor maybe in the area that you're looking to buy? If you need help with any of those, I ask you to do this. Either 1, give us a call, 844-775-5626, or click the Apply Now button. Fill it out as much as you can, and within 24 hours, I'll have a mortgage associate get back with you and answer any and all the questions that you have to hopefully get you into home ownership in 2023 if you want it. So thanks for watching, guys. I know it was a long one, but there was a lot of data to cover today. If you want to find out more about me and my team, all I need you to do is visit us at therateupdate.com. God bless. Thanks so much for watching. Don't forget to give us a thumbs up and subscribe down below. It helps us get recognized by more and more people on YouTube. So thanks again, guys, for watching. God bless. See you tomorrow. Bye-bye.